Manish Jain from Centrum is now with us to discuss the market fundamentals and his top ideas. Manish, what have you made of the action that we've seen? December is usually a good month where Santa comes. Historically, December has given about a 2.5% kind of return. So far, there hasn't been any sign of that. What are your conversations with investors like? You're in
Sorry
mute.
for that, yeah.
No. Go ahead.
So I think it will take about a couple of more months for the market to kind of recover from here onwards. I think this is something that we've been maintaining for over a month now, that at least till the end of January, when we are like halfway through into the Q3 results season, the market is going to be fairly range bound. We are looking at 23,500 to 24,500, 24,700 as a broader range in which the market is going to continue to trade. Largely because if you look at the last couple of months, more bad news has come in as compared to the good news, right? I mean, the government capex has been much slower than what the run rate, was budgeted at the beginning of the year. The second quarter result season has been abysmal for most of the headline industries and sectors. Urban consumption has been slowing down. So there have been a number of concerns which have all converged at the same time, which is leading to this kind of a temporary pullback in the market. And I don't necessarily think it's the bad news, because given the kind of rally we've seen in the last 15, 17 months, I think sometimes a little bit of a breather, a little bit of a pause is actually good news. So I think it's not all unexpected in that certain sense.
Okay. Manish, I wanted to discuss the oil marketing companies and the sector as a whole, because they saw a sharp fall. The second quarter was very weak, but refining margins are now improving. Do you think there could be some interest in select pockets like oil marketing companies while the markets overall could remain range-bound?
Yeah, so our view has been very simple, that this is an opportunity. This whole correction that you see in the market is actually an opportunity to build positions from a bottom-up perspective. We are now going through a second round of sector rotation, which is underway as we are speaking, right? So you've already seen the kind of interest in FMCG that you saw in the first half of the year. It's kind of waning away now. So that is one space that has kind of lost interest. Pharma is another sector which kind of trading at peak valuation. There's a separate bull run which is going on in pharma, which is very contrary to the market. IT again has seen a significant amount of rally, but then again, I'm going to be a little more cautious in that space while building up positions right now. So in my view, what is probably going to happen is that you will see a revival of sorts in terms of the demand in the small cap space. I think that is one part where I would expect a lot of fresh investments to build up position. And in terms of sectorally, I would say farm, power, utilities, then again, oil and gas, defense, infra, hospitals, hospitality, real estate. These are going to be the sectors where we are going to be a little more bullish on as compared to the frontline ones, which is basically, banks or maybe even IT or pharma.
Why not IT? There seems to be a fair amount of consensus bullishness coming through on IT. Do you think the good news is in the price?
To a certain extent, yes. And there is a certain bit of a risk factor that I don't think anybody is factoring in at this moment, which is that if Trump comes back into power, he may not be able to do too much as far as actionality is concerned, but his views on immigration and visa and all these issues is fairly strong. So as and when that noise picks up closer to his swearing in, there could be a bit of a sentimental impact that is going to come through as far as IT sector is concerned, and that's something that is very similar to what we had seen at the beginning of his reign in the 2016-2020 era as well. So it's not very dissimilar. So you should expect some bit of a sentimental impact in IT coming through because of the regime change that is happening in the US. So purely from that perspective.
Okay. All right. So that is about the IT space. We spoke about the oil marketing companies as well. Do you look at chemical space closely, Manish? Because that space was buzzing in 2022, but come 2023, we saw that massive cuts in earnings, a very weak commentary as well. Do you think 2025 could be the year for the chemical space?
Well, at least we are building up positions over there, specifically in agrochem space, where I think there can be a fair bit of a run-up which may happen in 2025. So we've been selectively building up positions over there as well. So definitely, I think the sector as such seems to have bottomed out. The sentiment seems to have bottomed out. It seems like a good time to buy. See, remember, as a retail investor, the best way to make money in markets is very simple, which is swim against the tide. Buy when everybody's selling and sell when everybody's buying. It's as simple as that. So buying IT right now would probably not be the best of the ideas, but a beaten down sector, like for example, chemicals or agrochemicals selectively might actually be a great idea.
We just had one guest who was telling us that, he's taking a contra bet on metals for 2025. And his rationale was that the profitability of all metal companies is as low as it was, as a percentage of the overall profits, is as low as it was in 2001. And it's very under-owned, underrepresentative. So do you think metals as a contra bet could, be attractive for next year?
So that's something that we've already made a little bit of money on. In the last couple of months, we started building up position over there in our flagship scheme, Good to Great, about a couple of months back. Not exactly frontline metal, but more of a converter. And we've already made a decent amount of money over there, and we're still holding on to that. So yeah, I would agree.
And time to add on to platform companies, or do you think, again, the good news is in the price? Because 2024 belonged to the kind of returns that we've seen in many of these new age tech companies, and they've also justified it by turning profitable.
Yeah. No, you're absolutely right. See, India as a whole is changing. And as an investor, your mindset also kind of needs to change a little bit along with that. You can't keep looking at old economy stocks like, for example, cement or FMCG or retail or even metals, and then try and judge the new economy businesses with that old yardstick. It doesn't work like that, right? For example, when you look at an FMCG company or a tech platform company, they were not going to trade at similar valuations. There's not going to be a similar methodology. The growth trajectory is going to be different. So that's something that we've been doing both in the private as well as in the public space, in the equities part of it. And investors have made a decent amount of money over there. So the fact of the matter is these have to be looked at more from a top-down perspective. These have to be looked at more from a 10-year picture perspective. And if you're convinced that the industry is going to keep growing, for example, quick commerce, right? For example, food delivery. And if these sectors are going to continue to growing and these companies are going to be in the top 2-3, then nothing else matters. Your bottom-up analysis, your financial analysis doesn't necessarily need to be there. And you just go ahead and invest from a generational perspective, something which is going to be your legacy. So that's something we are definitely looking at. Yes.
Thank you. Thank you very much, Manish, for joining in. Look forward to one more conversation, perhaps, before the